The first speaker today is Robin Xing, Managing Director at Morgan Stanley, who joined the firm's Asia ex-Japan Economics Research Team in 2016 as Chief China Economist, leading the firm's macro and FX research on China. Prior to joining Morgan Stanley, he was an investment strategist at Goldman Sachs Investment Management Division. Previously, he worked as Director of China Macro Research at SAC Capital and Vice President and Economist at China International Capital Corporation. Robin's team was ranked #1 for economics in 2021 Institutional Investor All Asia Survey, and he was written extensively on China's long-term economic outlook. He has presented his views frequently to senior policymakers in China. So now let's welcome Robin to give his presentation. Robin, please.
Thank you, Yiping. It's my great pleasure to join this forum. It's also my second time after early 2022 on this extremely helpful discussion on global macro and commodity outlook. Last year has been a very tough year for most of our investors, for most of the friends in this forum. We had a lot of issues, including China's COVID lockdown, the geopolitics like the Russian invasion of Ukraine, and also for global DM, it's the surge in inflation and the tightening of monetary policy. This year, we do think the mood could be probably more upbeat from Morgan Stanley's global macroeconomic outlook. By early November, when we published the year ahead outlook, we have a title for the Chinese section called Reopening, Recovery, and Resetting. So we have been more bullish than most of our peers since we published that outlook. But of course, back then, the biggest debate is if China could reopen from COVID-0. And even if they reopen from COVID, what about all this housing deleveraging campaign? What about this private sector confidence crisis due to the on and off crackdown or regulation tightening in the last 2 years? Our view is China is still pretty much sticking to its own pragmatic approach, that consensus they have reached since 1990s, since the reform and the opening up era. That is, the economy is the foundation for social stability, for everything else, including national security, ideology, safety, everything need to be based on a healthy economy. But of course, in 2022, due to COVID and also the big party reshuffle, some of these self-cost correction to stabilize the economy and job market came later than people expected. But that doesn't mean they are abandoning that pragmatic framework. So when we published the outlook in early November, we have been predicting a change in COVID-0 policy. We have been predicting they are making that pivot to a more pro-business, pro-openness, pro-corporate, more pragmatic approach. Back then, I think we faced a lot of pushback. And that pushback also led to bigger concern on potential global recession for 2023, which is not a hard thing to imagine if you have US economy barely growing due to the Fed tightening, if you have energy crisis in Europe, and then you have China sticking to not only COVID-0, but that tightening stance against its private sector and housing. Of course, globally, we may face recession. So that's pretty much this macro backdrop in early November when we published the outlook. We have been more bullish, but what happened in the last 3 months, since November, even probably beat our own expectation. The reopening in China is faster, earlier than anybody expected. And they made that quick pivot to that pragmatic approach I mentioned. And that pragmatic approach is not just about using lockdown, normalizing people's daily life. That also includes reviving private confidence by going back to that consensus reached in China in the last 2 decades. Economy and economic growth and prosperity is the foundation for everything else. So they are trying to revive the private confidence, the animal spirit of the entrepreneurs. Last but not least is the Western-China relationship. If you have keep escalating geopolitics, if you have all these tensions between China and the Western world, it will affect global trade, global FDI, global capital flow, and that's bad for global growth, also for the risk premium on a lot of things, including on Chinese currency, Chinese investment. But we have seen them not just pivot to domestic COVID policy, economic policy, regulatory environment towards pro-business, pro-corporate, but also a more pro-openness, getting back to that business mood to stabilize Western-China relationship. Taking their diplomatic efforts as an example, since November, they have some reshuffle on the foreign policy-making community, and the approach so far, despite all these noise from the Western countries, including the chipset ban or something like this reverse surface on FDI inflow to China, China's reaction remains quite measured. Try to look for stabilized, more predictable relationship between China and the Western world, which will be good for growth and capital flows. So this is not just a reopening from COVID lockdown. This is about reopening, followed by getting the private confidence recovery, and followed by stabilizing Western-China relationship. That's why we think you should not underappreciate how much room for Chinese recovery for this year, given all policies are finally aligned. It's not just the COVID management, but also economic policy, regulatory environment, even global and China relationship. So this will probably push growth to above consensus level. We are at something like 5.7%, probably the most bullish among Western banks on Chinese growth for this year. And for 2024, we have a 5.2%. So for this 2 years in a row, 5.7 for this year and slightly above 5% for next year, we are above consensus. And so far, we have seen some encouraging signals from China's high frequency data, from the policy initiatives, and also from some of the fundamental factors here supporting this strong and early recovery. Taking the consumer side as an example, the Chinese consumer's balance sheet has been quite healthy. There has been some excess saving in the last 2.5 years. And once the reopening is in full swing, getting back all this business in offline interaction, services sector, dining, travel, entertainment, restaurant, and shopping, we think it will bring back roughly 11 million jobs, given the lockdown last year costed them about 11 million underemployment. That's going to create a much stable job and income expectation for the lower income population. That's also positive for consumption recovery. So some excess savings, largely led by the high income group, and a better job market outlook, largely led by the services sector, the lower income population, it will support a strong recovery in the consumption sector. We are looking for 8.5% consumption growth for this year from almost a recession last year. Now, that's largely a services and the domestic consumption story. What does that mean for the rest of the world? The spillover to China's trading partners, to global asset class, including today's topic, to global commodities. Well, I would say it's a mixed picture. Because it's largely a service turnaround story, a lot of this will be driven by travel. And we can see from the Chinese New Year holiday data, all these bounce back in passenger traffic, in domestic travel, even in some outbound tourism, like Chinese visitors to Macau and Hong Kong start to surge again. Not back to pre-COVID 2019 level, but the momentum seems to be quite strong. The recovery is not completed, but we do believe by summer this year, you will see domestic travel largely back to 2019 level. And by end of this year, you will see outbound travel probably also going back to that pre-COVID level. So this is all about travel, about consumption, about services. So countries who rely a lot on Chinese outbound spending, they will benefit most. We can name a few like Asian countries, but this is not a typical China stimulus story. We all know in 2008, in 2015, whenever China had some economic recession risk, they have done some counter-cyclical easing, mostly ended up with some bazooka in either infrastructure or housing. And that helps global commodities, particularly the hard commodities, things like metals. This time is different. It's largely services and domestic consumption turnaround story. A lot of trading partners will benefit, but we don't think it's a bazooka for CapEx. For CapEx side, it will be better than last year, but only moderately better. For example, if we combine housing and infrastructure, the two commodity intensive sectors, last year it was largely flattish because housing was pretty bad. All these housing investment, transaction volume declined big time. But they did a lot on public capex, on these local bonds, and using the fiscal reserves from previous years, and using the relending program from PBOC to support public capex. So net-net, if you combine these two, housing and the infrastructure, last year showed something like a 1% growth. It's pretty much flattish. This year, we are looking for a 4% growth if we combine these two sectors. It's slightly better than last year's growth rate, given the housing sector will be less of a drag. There will be more and more easing measures, including the tier 1 cities, large cities like Shanghai, Shenzhen, Guangzhou. We do expect the government to loosen the second home purchase, the down payment ratio, the mortgage rate, all these purchase restrictions for second home in these large cities will be relaxed quite soon. Plus all these liquidity support for developers. By second quarter this year, we think housing volume could gradually go back to positive territory, showing some positive year-over-year growth. But don't get us wrong, we are not looking for a V-shaped recovery, given China is also facing structural headwinds like population aging and a lot of slower potential growth factors. And that means the housing sector has passed its peak structurally, that 16 or 14 million units recorded from 2018, 2019, 2020, that was the peak. Some of this trading volume of the housing sector was supported by so-called speculative demand. Now, if we take away this speculative demand, just to focus on the the family formation ratio, the pace of urbanization, the so-called genuine demand or upgrading demand, then we think the new equilibrium for the housing sector is probably 10 to 11 million units transaction every year. So that's definitely way lower than the recent peak recorded in 2020. So it's not a V-shaped recovery, but it will start to stabilize this year, and housing sector will become less of the downside risk for the economy. For the infrastructure, well, at the best, they will try to widen government deficit. They will try to increase the local government special purpose bond again. But even with all these more expansionary fiscal policy or budget, it's not enough to offset. Well, last year, there has been a lot of fiscal reserve. This money paid by PBOC and other central agencies to central government to basically pay for the shortfall due to government revenue. That part, the fiscal reserve, are largely gone. So if you look at the broad-based deficit, so-called augmented deficit, it may start to consolidate. It may start to narrow a little bit, particularly by second half of this year, if housing or private confidence stabilize. Countercyclically, the policymakers will consolidate on the fiscal side. So we think at best, infrastructure capex could remain at a decent level, maybe 7% growth for this year. But if you combine housing and the infrastructure, it's probably 4% versus last year. is slightly better, but it's not a bazooka. So we understood when people are talking about China reopening, the turnaround story in China, a lot of the investors, I believe some audience online probably thought about, okay, commodity exporters will benefit, metals, iron ore, everything. But we do think it will benefit just marginally, while a bigger story is the services turnaround, and that may have more spillover to China's neighboring countries who benefit from the outbound spending, who benefit from oil price, because oil is also one big component for travel, for consumption. This is slightly different from previous decades China turnaround story. But this is not the whole picture. I think the most important debate right now is this China turnaround story a tactical trade, like lasting for a few months, or this is really something like a sustainable structural story? Back in October, November, when I was in the US and Europe, meeting with a lot of asset allocators, and in Singapore in November, we did that big Asia summit. I think most global asset allocators, including some multinational firms who have real business in China, are getting very, very pessimistic on China's long-term outlook. The COVID-0 has lasted too long. All these geopolitical concerns, diplomatic tensions, and also for a lot of people, they see the 20th Party Congress as a big pivot from economy first to security first. We don't think so. In fact, we told most of these asset allocators and the global firms, the Party Congress itself is much more balanced than most people expected. Yes, they did mention more on national security. However, they kept economic development as the first priority. That's probably the most important takeaway from the Party Congress. And because of that, we have been predicting in our annual outlook in early November, they will change COVID-0, they will give local private companies more room to grow, they will wrap up all this regulatory tightening, and they will try to be more pragmatic on diplomatic fronts. Now, in last 3 months, most of these initiatives have turned out to be true, or even better, stronger, faster than we thought. But is this just some short-lived concession because the economy was in such bad shape? There is a social instability concern, so they try to stabilize the economy and job market. We don't think so. We think the framework China has adopted since 1990s, that economy and prosperity is still the foundation for everything else, including national security, social stability, or any ideology-driven initiatives. That framework is still there. Last year, COVID and the reshuffle probably has led to some delayed reaction based on the framework, but that doesn't mean they abandoned the framework. So going forward, we do think the economy is back as the central topic. Of course, that doesn't mean they will be back to this Wild West type of growth. First, there is definitely tighter regulation because they want to narrow income gap. They want to put a lot of regulation on leverage, on environmental costs, and there is also initiatives on self-sufficiency given the US-China tension. So all of this means now growth with all this regulatory change should be lower. But that doesn't mean they don't care about growth anymore. Our estimate is beyond this and the next year, the medium-term growth for China should stabilize at around 4%. And of course, the later approaching 2030, the growth rate should be even lower given the population aging. So the labor input and the capital input will continue to fade. And by 2030, China will probably be growing at 3%. But these are still quite respectable growth. Think about globally, every country is facing the payback time either from inflation, leverage, or supply chain reordering. We think even with a 4% or slightly above that growth, China is going to contribute 1/3 to global GDP growth. So that's still quite respectable growth. And that's enough for China to become a high-income economy, even doubling its per capita GDP from today's $12,000 to more than $20,000 by 2030. So that's about China, a slower growth path, but the economy remains their central policy agenda. And that means that the framework will be more pragmatic. Now, what about the risk? What about the geopolitics? What if there is a further escalation? Well, we do think the US approach seems to be more like competitive confrontation. So they want to see some functional decoupling, which means in certain areas like the high tech, strategic tech area, they want to see some decoupling, so-called small yard, high fence, that type of strategy. But that won't be applied to overall trade because the Chinese economy, US economy, and the Western world are so much intertwined. China accounted for so much in global supply chain, and there is just no second best alternative at this moment, given the ecosystem of supply chain, the sheer size of the skilled labor force and engineers and infrastructure. So we do believe for the mass market consumer products, the trade, bilateral or global trade will still be there. The trade link will be very strong, and it's also in line with China's interest. China is not Russia. If you look at any metrics I showed here, China and the Western world is so much intertwined. It exports more than $3.4 trillion goods every year, the Chinese economy, and half of that is going to US and the US allies. So 1 out of 10 jobs in China is directly or indirectly working for exports to the Western world, to the US allies. So China is quite pragmatic about that. And China relies on imports on these key metrics about energy, tech, food. None of these are self-sufficient for China. Their oil and gas import ratio is very high, not mentioning on the food side, soybean, and also on the tech side, like chipset. So for the Chinese policymakers, they will remain quite pragmatic. And we have seen that in the last 3 months with the renewed campaign on diplomatic front, try to stabilize Western-China relationship. After Davos, we believe China will try to have some high-level conventions and summit in Beijing very soon, inviting global business leaders and politicians, try to show they are back in business mood, try to stabilize the confidence level. And given China relies so much on trading and capital flow with the Western world, we do think, well, yes, after seeing all this regulatory reset and the geopolitics in recent years, for global asset allocators, investors, and multinational firms, they are also resetting their expectation. They are also doing stress testing. They are also asking for their new China strategy. But there's basically no way anyone is looking for a hard decoupling, a complete decoupling. So even after resetting the expectation based on a slower growth trajectory in China, but still quite a pragmatic policy approach, we think that means with the growth potential, the inflow to China will also continue. It will be lower than people probably expected a few years ago. But we think you will see probably more than $100 billion inflows to Chinese portfolio, including equity and bond every year in the next 10 years. And that means by 2030, the Chinese yuan will be probably more than 5% of global reserve assets, so surpassing Japanese yen and the British pound. So that internationalization of R&D assets, that capital flow story is still there. It's slower, but it's not a retreat. That's about the Chinese opening up and R&D internationalization story. But of course, there is a lot of debate on the FDI side, given the reverse surface from the US, potentially on the high-tech investment into China, on the chipset ban. Well, if you look at the FDI, I want to bring a few things. One is FDI now accounts less and less for Chinese fixed asset investment. So in terms of importance, from the numbers, it's getting less important than 2 decades ago. Today, the US FDI is owning 2% of China's total FDI inflow. And the US FDI to IT sector, to computer sector, is less than 1% of China's total manufacturing FDI. So it's a very small portion of the capex in China. You may argue, well, that might be true, but what if the cutting edge investment, the most innovative investment is still largely from US or DM FDI into China? That's partially true because we all know China learned so much from the spillover of FDIs. Taking Apple supply chain as an example, you have Apple in China, then you have all these suppliers growing up, nursing that ecosystem, then you have a local phone brand. Now they duplicated that success in EV supply chain. You have Tesla supply chain, battery, components, everything. Now you have saying China becoming the second largest car exporter in the world, and it's on its way to surpass Japan becoming the largest one, given its competitiveness in EV. Not the foreign brands, but also the national brands are booming. But what if the US and the DM are putting more and more restrictions? We do think that may affect China's productivity growth, but there are still low-hanging fruits in China. They can try to offset these things. Urbanization is still happening. Manufacturing upgrading is still happening. Even for domestic digitalization with domestic money, domestic firm, that's still happening. If you look at the Chinese exports, the number of foreign companies in Chinese exports, contribution in Chinese exports has been declining in the past decade. It's more and more led and dominated by Chinese firms in Chinese exports. And it's no longer exporting clothes. It's more exporting cars, capital goods, biotech, and all these home electronics. So it's a clear moving up in the value chain, given the domestic ecosystem and some of the favorable policy on green transition. So we do think net, we will see slower growth in China with the structural headwinds on population, on supply chain reordering, on some of the restrictions on high-tech FDI. But a 4% CAGR growth in the medium to long run is still respectable growth. And we believe that means all this story about China will be ending up in a lost decade was probably wrong. We have seen that change in last 3 months, that pivot to a more pragmatic pro-growth change. We think it will be sustainable. With that, I will stop here and hand over to Yiping.
Okay, thank you very much, Mr. Xing, for the presentation.